Good afternoon, and thank you for joining us for this installment of Epic Insight. This is Brian Lenz, Director of Sales and Strategic Partnerships here at Epic Retirement Plan Services, and I'll be your host for today's call. We're excited to be joined by the one and only Ken Entenmann from our NBT Wealth Management family to share with you a less than dry economic outlook. Ken is a Senior Vice President and Chief Investment Officer at NBT Wealth Management, and he brings to the table over 33 years of investment experience and oversees more than $6 billion in assets under management and administration in trust, custody, retirement, institutional, and individual accounts. Ken is a former board member of the New York Bankers Association and was the chair of the Trust and Investment Committee. He served on the board of the Central New York Community Foundation from 2006 to 12, and he currently serves on the Roman Catholic Diocese of Syracuse Investment Advisory Committee. He's also earned his CFA designation. As always, your line will be muted throughout the call, but if you have any questions for us, please feel free to enter those in the GoToWebinar questions panel there, and I will run them by Ken at the conclusion today. Without further ado, Ken, take it away.
Well, thank you, Brian, and good afternoon to everyone. It's a beautiful snowy day in upstate New York. Hopefully you're doing better where you are. But as we kind of come to a conclusion of 2019, I think there's some lessons to be learned in the marketplace, and also those lessons might help us as we look into 2020. So we start off with a picture of a pretty famous American in the spirit of the season, the Grinch. And, one of the things that I would caution people is to talk about, all the noise in the marketplace. It is really quite amazing when we look at the world. The Grinch, he complained about all the noise. They bang tong tingers and blow flew flounders and crash jang jingers and bounce boy bongers. And I really think this world that we live in today, there is just a ton of noise out there, and I think it's really impacted the way the market is traded. And when you look at today's world, there was a recent survey done of investors on CNBC, and a total of 60% of the respondents answered a survey question that the stock market was either flat or down for 2019. I mean, that's really remarkable noise when you think about it. The S&P is up over 27% year to date. That's a pretty big miss by the survey, and I certainly think it's because of all the noise in the system. And when we talk about noise, I think this word cloud gives you a pretty good idea of what we're talking about. Some of the noise is louder than others. Certainly in the last few weeks, tariffs have been front and center. We just completed the earnings season for the third quarter. Impeachment continues to generate all kinds of headlines. But when you look at this page, the FBI, Game of Thrones, Fortnite, gold, Venezuela, Hong Kong protests, you just can't go anywhere without there being noise in the system. But the reality is most of this noise is just that. And when we really look at the numbers, both from a market standpoint and from an economic standpoint, what we conclude is that we're really on solid operating. We really have a solid operating environment and a pretty good foundation. And because of all this noise, and I give probably 20 or 30 of these presentations a year throughout primarily the Northeast, but hopefully some of you were at the Epic conference down in Naples. So I do a number of these. And just about everywhere I go, one of the things that I contend with is everybody wants to know when we're going into a recession, because it's been so long that since we've had one, there's this general feeling, this negative impulse that we're due. And what I would suggest is economic expansions don't die of old age. They die for other catalysts. And when we look at recession risk, historically there are three primary catalysts, and I think we can go and examine whether these exist. So the first one is just an event-driven risk. This is a photo, obviously, of Pearl Harbor. and the entrance of the U.S. into World War II. But plenty of events that set an economy back, whether it's full recession or slowdown in economy. And almost by definition, these things aren't predictable. They just happen. They could be natural disasters, Hurricane Katrina in New Orleans, the Northridge earthquake in California. They can be man-made, the Arab oil embargo in 1973, the terrorism attack of 9/11. But all of these things are kind of unpredictable. And so we're going to kind of put that one off on the side. But the other two reasons why recessions have occurred is, first, it's kind of a cyclical recession. Historically, this was driven by a deep cyclicality in the economy, and I'll talk about that in a few minutes. And it's also been, the evidence is quite clear that the Federal Reserve, I have a picture of Fed Chairman Powell here. The history of the Federal Reserve in causing recessions is actually quite robust. Earlier this year, President Trump took a lot of heat because he called the Fed his greatest enemy. I found that kind of interesting, and that Donald Trump has a pretty long list of enemies, and for the Federal Reserve to be the greatest one is, saying something. But we'll explore that and talk about what that means. And then lastly, recessions are caused when there's either a structural or an asset bubble, and those bubbles burst. And really, the last two major recessions that we've had in the United States were coming out of the late 90s, where we had a stock market bubble driven by the dot-com mania. And then again in 2007, 8, or 9, when we had a financial crisis largely driven by a housing bubble, where everybody was buying condos in Florida and Nevada and Arizona, California, and trying to flip them. And when that housing bubble burst, causing a pretty big financial crisis, causing the collapse of some major Wall Street firms, Lehman Brothers and Bear Stearns, the most prominent of those firms. So what we're going to do is explore to see if we see any of this cyclicality in the economy or asset bubbles. And my conclusion is I really don't see too much on the horizon that will imminently put us into recession. And I think it's kind of steady as she goes. So when we look at 2019, there were really four worries that were really driving market volatility. And those worries were fear of a global economic slowdown. And there is no doubt that the economy here in the United States slowed in 2019 from a trajectory just shy of 3% in 2018 and slowing to an area of somewhere between 2 and 2.5%. If we post a 2% growth in the fourth quarter, which is somewhere around the consensus, 2019 economic growth here in the United States would be about 2.5%. And we also see slowdown around the world. The IMF has reduced worldwide growth for 2020. So we've certainly seen a slowdown in economic growth, but it seems to be stabilizing. And there is a big difference from a slowdown, which is a change in the rate of growth, and a recession, which technically is defined as 2 consecutive quarters of negative growth. So we'll explore that. Another fear that we had, and this was really rampant this time last year. If you think back a year ago, the market was kind of in free fall. Starting in the third quarter, there was a very strong concern that the Federal Reserve, so we talked about the cyclicality of the recessions, and the Fed was adamant that in 2019, their plan was to raise rates 3 or 4 times. And the market was concluding that the economy was in fact slowing and that couldn't reconcile those two. And we had a pretty nasty correction in the fourth quarter of last year, with the S&P 500 losing peak to trough nearly 20%. And that fear that the Fed was going to raise rates and choke off economic growth was very prominent throughout 2019. And we'll talk about the history of that and where we are today. Trade wars obviously have been really ongoing for 18 months now. The negotiations started 18 months ago, and we have had these fits and starts where everybody was optimistic, and we had all these talks about friendship and good guys and partnerships. And every single time we seemed to push the rock up the hill, Sisyphus lost control and the rock fell back down. And just in the last few days, we seem to have an agreement on phase one of a trade agreement. And we'll talk about the impact of that. And then lastly is just basic plain old corporate earnings and the fear that a combination of the top three would result in an earnings recession. And the fact of the matter is in 2019, we knew earnings were going to decline because of the tax law changes that occurred in 2018. So that had, in 2018, we saw earnings grow around 20%, but about half of that was driven by taxes, corporate tax reform, and 2019, we grandfathered that in. So we knew we weren't going to grow at 20%, so we knew earnings were going to decline. But even for adjusting for that, the forecast for 19's earnings were really draconian. And it turned out they came in okay, and we'll explore that. So as an outline, we'll talk about these fears, how they currently reside in the marketplace, and see what that may mean for 2020. So let's go ahead and we'll talk about the economy first. So are we in as I go around the country, I'm constantly asked, are we in the 7th inning, the 8th inning, the 9th inning of economic expansion? And as I said, economic expansions don't die of old age. They typically die with some catalyst. So if you look at the chart on the top right, you can see the three bars. So 3.1% growth in the first quarter of this year, followed by 2 quarters of 2.1% growth, and a forecast for the fourth quarter around 2%. If you do the math, that gets you about 2.5% growth for 2019. So yes, the economy slowed from that 3% area down to 2%, but it seems that the economy is stabilized there. When I look at the bottom part of this to answer the question, are we in the 9th inning or 8th inning or 7th inning? I've spread this out because this question has been asked for 3 or 4 years. So, earlier this year, my New York Mets lost a game 27-3, and the 9th inning lasted about an hour and a half. So I'm not sure that analogy works well. But I think the chart on the bottom is really important. And what I think it demonstrates is that today's economy is not our grandfather's economy. And what I mean by that, our economy is far less cyclical than it has been in the past, and that our economic expansions are longer, and therefore there's less opportunity for recession. So if you look at the blue bars, really all of the expansions that occurred prior to 1980, when you look at the dates, you just start at 1904, 08, 12, 14, 15, 21, 24, 27, so on down the chart. You can see that economic expansions occurred every 3 or 4 years. I mean, that's the cyclicality of our grandfather's economy. When you look at the maroonish bars, and if you look at the dotted line that goes through, the average length of an expansion from 1904 through 1980 was a little over 3.5 years. So kind of this feast and famine, recession, expansion, highly cyclical economies. And you can see a lot of peaks and valleys in those economic expansions. When you look at the maroon bars, these are the last 4 economic expansions, and it's pretty easy to see that expansions are longer in nature, so that the average of the last 4 expansions from 1981 through 2019, the average is a little just shy of 9 years, and our current expansion at 11 years is the longest expansion in the history of the United States. And again, it's led lots of people to talk about the 9th inning of the game. We're due for a recession. and all of the noise that we talked about in the introduction just fuels that negativity. And in today's 24/7 world of media, all that negativity gets amplified, and it leads to a lot of negativity when the reality is, I think the economic foundation of our economy is in pretty good stead right now, and let's explore why we think that. So again, this is the GDP, and it breaks down what consists of GDP. So you fans of macroeconomics in college may recognize the GDP formula here, which is C plus I plus G. Consumption plus business investment plus government spending minus exports is the major components of GDP. And I think this chart is interesting for a couple of reasons. One, it speaks to the cyclicality or lack thereof that we experience today. So first, lots of noise in the marketplace about housing. Just earlier this week, builders' confidence came out as high as it's been in years. It seems like those millennials who have been delaying purchasing houses are starting to come into the marketplace. And because the housing starts have been so weak, there seems to be a shortage. So there's optimism there. But when you go back to the 1950s, housing was almost 10% of our GDP. Today it's 3.7. So housing, while still a very significant and important piece to our economy, is only about 3.7%. Government spending, the maroonish bar, typically hovers between 17 and 21%. And when we talk about the size of government, we'll talk about government debt in a little bit. But government kind of at the low end of where it has been in GDP. The next bar, the gray bar at 13.7, is investment ex housing. This is pretty much a proxy for business spending. And again, when you look at that number is much, much lower than it was in the 1950s in our grandfather's economy. And because business investment is cyclical and you combine business investment with housing, it's a much smaller component of today's economy than what it was 25, 30, 50 years ago. And therefore, those are two of the major sources of cyclicality. And so it helps smooth out the economic activity that we've been experiencing, and in some respects, it helps extend economic expansions. Dropping to the bottom, you see net exports at minus 3%. We'll talk about tariffs in a little bit more detail in a few minutes, but it speaks to the tariff wars have garnered so much headline and so much negativity and so much infighting between the people in favor, against, all of that. There's clearly pockets of winners. There's clearly pockets of losers. But in the total scheme of things, net exports is minus 3% of our economy. It's just not that big of a number to have a meaningful impact on the economy, despite all the headlines that we get almost on a daily basis about trade with not only with China, but with our other trading partners, whether it's USMCA with Mexico and China, taxes going on, European products, etc. The biggest thing that I want to highlight with this chart, and the reason why we're so optimistic that at least the first half and probably all of 2020 will largely be a period of growth, is that our economy is 68% consumption. So you've probably heard this before. So when you look at C plus I plus G, the C is by far and away the biggest factor here. And so what is consumption? It's individuals like you and I going out and buying stuff, whether it's autos or clothes or kitchens, you name it, we're buying stuff. And with the economy being 68% consumption, the most important thing for us to do, in my opinion, if we're going to look to try to forecast whether we're imminently going to enter recession, is ask, well, how is the consumer doing? What is their financial situation? Is there something that concerns us about it? And from my perspective, the answer is no. And in fact, it's quite the opposite. So this picture here is a picture of my local Lowe's home improvement store in Auburn, New York. And I think the picture speaks 1,000 words, as they say. It really speaks to how tight our labor markets are. Everywhere I go, I was in Manchester, New Hampshire on Wednesday, Portland, Maine a few weeks earlier than that, Plattsburgh, New York, Burlington, Vermont. Everywhere I go, when I have an opportunity to speak with our clients, the commercial clients of MBT Bank, and they really run all through the gamut of industries and businesses, virtually all of them are complaining about their inability to find skilled laborers. So this is just a sign in front of the Lowe's store in Auburn, New York. Join our team. On-the-spot interviews every Wednesday. And my guess is nobody showed up for an interview on Wednesday, so they stuck a stake in the ground and said, Friday too. Show up on Friday. Maybe we can get somebody to come in and interview. And I think I got a chuckle out of this, but it really speaks to how tight our labor markets are. And the chart to the right really speaks to that as well. So the black line is the unemployment rate. You can see it goes back to the early 1970s. And obviously at the far right, you can see that peak in unemployment following the financial crisis, unemployment getting up to 10%, and a very steady but precipitous decline, so that our unemployment rate in November is actually 3.5%. So it shows pretty much historically low unemployment in the marketplace today. The light blue line is wage growth. And I think this is really important in terms of the health of the consumer as well. So if you go back to the great financial crisis in '07, you can see as unemployment rose, wages declined rather dramatically, and that's kind of consistent with what history tells us would happen. But what was different this time was wages. When the economy started to recover and unemployment started to drop, wages stagnated. And this led to the political narrative that the average consumer hasn't had a raise in 10 years. And you can kind of see it if you eyeball that chart from maybe 2013 through kind of the middle of 2017, wages kind of flatline. So there's some merit to the argument that the middle class wasn't getting a raise. However, what you see now is that wage growth has picked up rather nicely, growing somewhere in the neighborhood of 3.5%. And when we break down wages and look at quintiles, so you stack rank them from the highest wage to the lowest wage and put them into quintiles, all 5 quintiles are experiencing wage growth today, and the bottom quintiles are experiencing the highest growth in wage increases. So what that tells me is the consumer is in pretty good shape. And until I see either one of these numbers start to deteriorate, and the most recent numbers were off the charts good, until I see some kind of rollback of these numbers, I'm going to remain fairly positive in my economic outlook. If anything, and one of the things that I would caution you on is if in fact job creation starts to slow, one of the questions we're going to have is it because the economy is starting to slow, and in fact, a recession may be coming, which might be one reason why things are slowing. But another reason why job creation may slow is we may be just running out of qualified workers to hire. And if workers, and like I said, most companies I talk to are complaining about just that all the time. So looks good there. Inflation is running rather benign. If you look at the table in the top right, the chart gives you CPI. So the inflation numbers are running, if you look at CPI and core CPI, running right around 2%, which is kind of the target for inflation. But when we look at that headline PCE deflator, that's the personal consumption expenditure index, that is the Fed's chosen target. So when the Fed says it has a 2% inflation target, that's the number they're talking about. And at 1.3%, we got a long way to go inflation-wise before the Fed is going to get spooked. And in fact, the recent language coming out of the Fed is saying, we're going to let the inflation, we have room for it to run, and we're going to let it run hot. So I think that speaks to what's going to happen on the Fed side. But the bottom line is you have consumers with more money in their pocket because of the strong earnings and wage unemployment and wage numbers, with very little inflation, and that's a really positive message for the potential spending, and we look forward to a pretty strong, and all indications are that the holiday spending season is off to a good start. And even on manufacturing, again, I caution you that manufacturing is not what it was in our grandfather's economy. And yes, in fact, it has slowed. I think the tariffs had their biggest impact in this manufacturing. But this is an oscillator index, and when you're below the red line, things are slowing. And we've barely scratched that surface, and it does appear that things are starting to turn around on this front. So something to watch, but I don't think catastrophic. And as I mentioned earlier, the home builder confidence is one area of manufacturing that has been weak, and maybe perhaps signs of seeds of growth there. So pretty positive about the economy because of the consumption-led economy and the strength of the consumer, and we don't see that changing. Let's turn our attention to our second thing, which is the Fed policy. And this chart goes back a couple of years and gives us the slope of the yield curve. So again, this time last year, the market was in free fall. The Fed was forecasting 3 or 4 rate hikes. And you can kind of see it in this line. So this is the yield curve, just mapping out treasuries, starting with short-term rates going out to 30-year treasury bonds. And you can see the yield curve as it ended in November 30th of 14, 16, 18, and 2019. And you can see back in 14 and 16, the yield curve was somewhat positively sloped, very flat in the front end. That's the zero rate policy of the Fed. And then you can see in 18 and 19, you can see the Fed starting to raise rates, and the yield curve was flattening. A flattened yield curve is scary. It's kind of the harbinger of doom for the marketplaces, particularly when that yield curve gets from flat to inverted, when short-term rates are higher than long-term rates. And right now, the chart shows 17. That's since we submitted this presentation, the market has increased a little bit, so that yield curve is now 25 basis points as of this morning. So we're getting more positive, which is a good sign. But why was Fed policy such a big concern? And this chart, I think, is really powerful. So the way that we measure the steepness of the yield curve, or the most common way of doing it, is to take the difference between the 10-year Treasury yield and the 2-year Treasury yield. So as of about a half hour ago, the 2-year Treasury was trading at 163 in yield, and the 10-year was at 188. So that's the difference is 25 basis points. When that 2's 10's difference goes inverted, that's when people get spooked. So again, it ties back to Donald Trump's comment about the Fed being his worst enemy. And this chart, to me, tells you why there's some truth in that statement. So the line itself, the gray line running through the chart, is just simply the difference between 2's and 10's. So when the line is above that zero line, the yield curve is positively sloped or normally sloped. But when it's below the line, the yield curve is inverted. So why does the market get spooked when you're close to an inverted yield curve? And the answer is the gray bars. The gray bars are recessions. And so when we talk about the Fed causing recessions, when the line is colored blue, that is when the Fed is raising rates. So the Fed raising rates either too fast or too far in a fast way forces the yield curve to invert. And when you look at when that line is blue, and then when you look at the gray bars, 7 of the last 9 recessions going back to the 1960s, 7 of the 9 were preceded by an inverted yield curve. And that's why last year's numbers were so scary. And where are we today? Well, the Fed has more or less said we're on hold. They cut interest rates 3 times in 2019. They have effectively said that they're on hold for now. In their last minutes, they basically said they don't anticipate doing anything at least until the middle of next year, maybe not at all. So there's huge relief in the marketplace, and I think the recent strong performance of the equity markets is largely in relief that the Fed has basically declared themselves to be on hold. And this chart tells you historically why the inverted yield curve is such a harbinger of doom. And I think for the time being, now 25 basis point positive slope is not a steep curve by any stretch of the imagination, but we were negative back a few months ago. So we're moving in the right direction. And with the Fed on hold, we've kind of taken that wall of worry brick off the table. So let's turn our attention to trade wars. As you know, over the Thursday, Friday of last week, throughout the weekend, there's been news of a trade deal. It has not been signed yet. We're waiting for translations, etc. But the net of that trade war, or that phase one agreement, is that China is going to agree to purchase about $200 billion in U.S. goods, of which about $50 billion will be ag products. And in return, the United States will not implement the 15% tariffs, 25% tariffs that were due to go on December 15th, which was, I think, Sunday, on about $150 billion of goods. And not only did they agree not to add to tariffs, they agreed to partially roll back some of the existing tariffs. And that proved to be a big relief for the marketplace. I happen to think that this was kind of the low-hanging fruit, and we haven't really touched on the more difficult issues. So for the time being, I think there is relief that the trade war is not getting worse. Is it marginally better? Yes, but I would say marginally. When we look at China, the number for ag product is somewhere around $50 billion. Last year, they purchased between $26 and $28 billion. So it's not that big of an addition. I would also add that there's actually a pretty serious epidemic of African swine fever in the hog population in China, so that 50% of their hog population at last count has died, and there's a tremendous shortage of pork, which is the primary protein source in China. So, them agreeing to buy more pork is not exactly a magnanimous gesture on their part. They need it. And us agreeing not to put incremental tariffs on is not that big of a deal either. But what I do think the reason why the market is happy about it, it's not getting worse. And then secondly, when you look at the equity markets, the earnings forecast for 2020 largely had those tariffs built in. So the fact that we've had relief is leading analysts to look at their earnings estimates. And so there's a hope that you're going to see some positive earnings revisions as we go forward on tariffs. But that being said, there's going to be no instant gratification on trade wars. We still have some really tough issues to talk about in China. State-owned enterprises, they wickedly subsidize their industries, particularly heavy industry like steel and aluminum. They subsidize them because they're really employment policies, not economic policies. And then those state-owned enterprises are able to sell those products on the world stage at sub-economic price, call it dumping if you would. That's a hard thing to fix. Joint venture requirements, one of the hopes that I'm not sure I haven't seen the language, and the market is hoping that we're going to get better access to China. In the past, in order for a U.S. company to do business in China, they were required to form a joint venture with a Chinese company. And with that came sharing of intellectual property and business practices, and that was problematic. In particular, the banking industry has been looking to get into China, and I'm not sure where it stands, but there's hope that some of our bigger firms, like our big banks, J.P. Morgan, Citi, Bank of America, American Express, our Visa, MasterCard, they have not had an opportunity to get into that marketplace. And it's not clear whether we're going to get there or not. And in the past, they would have to form a joint venture. So that's something we have to do. And then lastly, and most importantly, it's estimated that about $800 billion in intellectual property rights are stolen every year from U.S. companies. And particularly, again, it's not our grandfather's economy. So reverse engineering a Ford car is not that hard to do. It's really easy to cut and paste a software package or a molecule for a pharmaceutical drug. And so intellectual property rights is really problematic, and the Chinese won't even admit they're doing it, let alone agree to stop doing it. So I would argue that these things are really the more difficult aspects of it. The reason we got phase one is because this is so difficult to deal with. So my view is it's not getting worse. That's a good thing. That may help earnings in 2020. That's a good thing. So phase one is signed. Now it's on to the more difficult things, and I think it's going to be with us for a long time to come. What's the answer to dealing with China? I think one, we need better trade agreements with other free countries, and we're doing that. We signed one with South Korea, Japan earlier in the year. The USMCA, which is the Canada and Mexico agreement, after a whole lot of jostling back and forth, appears ready to be signed and passed by the House of Representatives. So we think we're making progress there. I do think we need unified action as it relates to China, and I asked the question, who is our ally? So one of the main criticisms of President Trump was not that he was taking a stand. In fact, I think, particularly in this political world where everybody's biting at each other, there is pretty much unified agreement that we need to push back against China. The complaint with President Trump was more how he was going about doing it, using tariffs, not working with our allies. I do think now we're starting to see more unified action as it relates to China. And then who's your ally? The thing I would caution everybody on, and the reason why I think this is going to persist, trade wars, is because we typically think of allies as our military allies. We think of NATO, so we think of Germany and the UK and France and Japan and South Korea, but they are really competitors of ours. And you can see in the recent weeks where France has proposed putting a digital tax, i.e. a tax on technology companies. There aren't too many big French technology companies, so it amounts to a tax on U.S. tech companies. And then our response is to tax Louis Vuitton bags and champagne and cheeses. So, it does question who our allies are. Germany is one of the leading exports of manufacturing companies, of automobiles. But I think we're starting to get there on trade. Operating earnings, I think one of the reasons why we're so strong is that we have been calling for an earnings recession. You can see that drop in 2019. That's largely the grandfathering of the tax reform that happened in 2008. And everybody seems to be calling for earnings recessions. And the fact is we keep grudgingly fighting it out. Whether it would be tariffs or higher interest rates, all of these fears that we're going to put pressure on earnings, our companies have done just a remarkable job and have shown great resiliency. And therefore, earnings have proven to be much stronger than the negative revisions that we've seen. And we see that continuing as we go through. Certainly, there's pockets that you'll find and anecdotal one-offs. So, for example, today, the announcement that Boeing is going to suspend production of 737 MAXs. That's clearly going to impact Boeing's earnings. Its stock price reflects that, and it probably will have an impact on the overall earnings picture and economic growth in the first quarter. But I think it's really easy to kind of separate that out from the macro view. So in short, we're still pretty optimistic on the earnings picture. So let's turn our attention to looking for bubbles. I got about 5 more minutes here, and we'll open it up for questions. And please type in questions to Brian when we get there. So we talked about the Fed and how they've been prone to cause recessions and how they seem to be sidelined. The other thing that commonly causes recessions is bubbles. And when I look in the marketplace for bubbles today, I don't really see too many. And doesn't mean I'm right. I just don't see any. This chart, I think, is really cool. It's put out by Goldman Sachs Asset Management. It looks on the left, it looks for financial imbalances in government and financial businesses and non-financial businesses and in households. And on the right side, it looks for asset inflation or asset bubbles, whether it be in housing, commercial real estate, consumer credit, business credit, or in the equity markets. I think it's neat because we can go back and look at 2006 And we know that was leading right into one of the worst financial crises. And you can see where the financial excess was. You can see it in the financial businesses. So think of the Countrywide Credits and the Lehman Brothers and the Bear Stearns of the world, Washington Mutual, and a whole host of other financial businesses that went out of business, Indy Mac. You can see it in housing. We know that housing prices were very much in a bubble, particularly in the Sunshine States. That had created some excess in consumer credit, and it also impacted the household. When you look at today, this chart is remarkably more calmer. And the interesting thing to me is if there was one spike, it's in government. And we'll talk about that in a little bit more detail. But I think it really is an interesting compare and contrast between the pre-bubble bursting in 2007 and where we are today. And I think this chart demonstrates that we're in far stronger financial shape than we were prior to the last major recession. In terms of the equity markets, so let's go looking for bubbles. Today, the PE of the stock market is modestly above, call it 18 times earnings, modestly above its historic average of 16 times earnings. Standard deviations, one above at 19 and a half, one below at 13. In short, if you're below the middle green line, stocks are cheap. If you're above the middle green line, stocks are expensive. If you're near the outer bands, that's when things get to be excessive. Today at 18 times earnings, yeah, we're pushing towards the upper band, but I think we're pretty safe that we're close, and you can see how we've toggled back and forth between 16 and 18 times earnings. So I think we're in pretty good shape. And then when you consider that interest rates are so low, and when you consider that interest rates were materially higher throughout the life of this chart, I'm not too worried about a 17 or 18 PE for the market. This chart is helpful in that it does show us what a bubble looks like in the stock market. So when you go back to the beginning of the chart, you look at how PEs expanded in the late 1990s, and then you can see the dot-com bubble crash and PEs come crashing down. We're a far way from a bubble in the stock market. What I will say, though, as we look at stocks, is I do think even though the overall market trades at a reasonable PE of, call it 17, 18 times earnings, I do think the market in the last 3 months or so has concluded that some of these high-flying growth stocks may have PEs that are a little bit too high. My personal opinion is the IPO market kind of started investors down a path where they were questioning that growth. So when you think of Uber and Lyft and Peloton and the fake meat company, what's the name of that one? I can't remember that one off the top of my head. And then most recently, the one that I think was really the straw that broke the camel's back on these high-flying tech valuations was WeWorks. Horrible corporate governance and a model that really wasn't a technology company. It was really a real estate company. And I think when that collapsed and that IPO was pulled, it really led the market to start to question long-term growth rates. And the history of the world is not kind to stocks that trade at 50, 60 times earnings with growth rates of 20, 30% out as far as the eye can see. And so I do think there is a subtle shift occurring. You can see it in the numbers that there's a little bit more, the investors a little bit more discerning in terms of PE ratios. And we've seen it where value has started to outperform growth. And we see it where international stock markets have picked up because they're materially cheaper as well. But in short, when I look for a bubble in stocks, I don't see it. Similarly, the next page, we talk about credit bubbles. And this chart, again, is really all it's doing is giving the incremental spread. The lighter line on the bottom is investment grade fixed income corporate bonds, and the darker line is high yield bonds. You can see where we are, where today spreads are really tight. Credit has performed really well. Default rates are at historic low levels. And normally I would look to the credit markets as kind of the first sign of an imminent recession. And boy, the markets are really well behaved. This chart too does give us a sense of what a credit market bubble looks like, and that's that 2007 period where I love it that the chart ends at 1,200 basis points above Treasuries, and the peak for high yield was 1,807 basis points above Treasuries. That's what a credit market bubble looks like, and today we don't seem to have one. So where would I look for a bubble? Last kind of point before we wrap this up is I do think government debt or sovereign debt is growing at as Jay Powell will say, in an unsustainable path. Or you can see the debt. This is just a Treasury debt outstanding in the United States, going from 11 trillion in 2009 up to $23 trillion today. And the reason why our government has been able to spend more money, and governments around the world has been able to spend more money, is that interest rates have been basically flat to zero. So even though the debt has almost doubled, is on its way to tripling in the last 10 or 12 years, the interest expense of paying off that debt, of servicing that debt, has remained relatively flat because essentially the government's been refinancing that debt at ever lower and lower rates. But it really begs the question, what happens if interest rates start to rise? And it gives me pause about that. Alan Greenspan was on CNBC this morning talking about how this is something that's unsustainable as well. So if I was looking at a bubble someplace and I look around the world, it's government spending and pushing deficits and therefore pushing debt levels that are really problematic. And this just shows you the spending. We're in a political season. Today, the House passed a $1.4 trillion spending, short-term spending budget to prevent a government shutdown, and it's filled with goodies like you wouldn't believe. And I love that the parties always jockey back and forth and tell each other how they're the responsible ones, and the other one is the spendthrift. This chart goes back a long time, and I challenge you to tell me which party is the more responsible party when it comes to spending. It seems like government just spends, right? And so I think that's a concern, and it's even a bigger concern when we look internationally. This chart is really cool, in my opinion, gives you the major developed countries, and then it goes out and gives you the maturities across the top of the page. And what we have now around the world is nearly 40% of all government bonds trade at negative interest rates. And that to me is truly unsustainable. And if I were to pick one area that really scares me, it's sovereign debt levels and negative interest rates. I really don't think we're going to know what the unintended consequences of negative interest rates are. I think it's going to be a great PhD paper for somebody in the future. But if I were to look to one area, and that Goldman Sachs chart had, where there might be a bubble, it would be in sovereign debt. So let's wrap this up. Economic, it appears our economy is stabilizing around 2%. It also shows that around the world, while weaker than the U.S., we're still the best game in town. It does appear that it's not getting worse, and it might be stabilizing with the possible exception of Europe. But China seems to be coming around. South Korea, Japan seem to be stabilizing as well. So stable economic environment. The Fed on hold for now, which I think is a good thing because the market got spooked last year. And I think the recent rally, the Santa Claus rally that we're experiencing is being fueled by that. The geopolitical risk, the noise that we started this conversation with, is not going away. Whether it's Brexit, France strikes in France, trade tariffs, all of that, it's not going away. So expect it, but more often than not, it's the noise that the Grinch complained about. There will be no instant gratification. We're kind of having a relief rally with the phase one announcement. Hopefully it will be signed. Wouldn't be the first time that we thought we had an agreement that faded away. But still, there's no instant gratification. The far more difficult things going forward are still out there on the table: state-owned enterprise, joint venture requirements, and the biggest, intellectual property theft. So what does that mean? We think interest rates will remain low by historic standards. It is my hope, if Brian invites me back next year at this time, that interest rates are higher, because that will tell me the economy continued to perform well and we have avoided recessions. But even if, so my expectation is rates will be higher, but I think they'll be modestly higher. And if you put it in perspective, the 10-year Treasury trading at what did we say, 188 today. If I look at the 30-year average, it's over 6%. We got a long way to go. Rates are still low. And then, so are we looking at the end of the negative rates? I hope so. Credit spreads really well behaved. I would keep an eye on that in terms of the canary in the coal mine of things are starting to slow down or deteriorate economically. But right now, there's no indication of that at all. And then lastly, we think the equity markets are going to be the place to be. They may be somewhat volatile. What's interesting today, information came out that the decade of the 2010 to 2020, where we got another week to go or so, but is one of the least volatile decades in the history of the stock markets. So we like to complain about the noise, but the markets have actually been pretty well behaved in the last 10 years. You'll find that pocket of volatility based on the noise, based on trade wars, based on Fed announcements. But right now, we don't see anything excessive in the markets, and we're pretty comfortable. So last, the sales pitch. This is the blog that I wrote, that I write for the bank. And if you're interested in signing up, you can subscribe at this site and check in. I typically write 3-4 times a month on the markets and the economy. It's just another source of information if you're available. With that, Brian, I will stop there and be happy to take any questions.
Yeah, appreciate the insight, Ken. I'll kind of close it out with the most common question that's rolled in. I think you identified really the number one suspected trigger in your mind might be the sovereign debt bubble. Well, I guess A, would you agree with that? And B, if that's your number one worry right now, are there any indicators that we should be looking for that this is actually going to trigger a recession in some way, shape, or form?
Yeah, so I would say that as much as I'm concerned about it, and I think the numbers speak for themselves when you look at the size of our debt and how much it's grown and the continued $1 trillion annual deficits, it doesn't appear that this is going to get any better anytime soon. And quite frankly, I'm the boy who cried wolf. I've been talking about this for 10 years. I think if inflation starts to pick up, that could be problematic. If inflation picks up and interest rates start to go up, at some point, higher inflation will lead to higher interest rates, and then that's when these high debt levels start to become really problematic. The United States is still by far and away the best game in town. When you go to places like China, Japan, their debt levels are 2 to 3 times the size of their economy. And so I think watching credit spreads around the world is what I would advise people to watch. What I would say, though, I don't think this is a clear and present danger as long as rates remain low. But if we start to see interest rates push higher, and if they push higher, it's more than likely going to be because the economy starts to accelerate and inflation starts to rear its head. If that happens, then I think that would cause me to be a little bit more alarmed. But as long as rates remain low, I don't think this is a clear and present danger and a catalyst of imminent recession. But I think it's more of a long-term concern that needs to be addressed, and we have a bunch of feckless politicians who don't want to go near it.
Well, I appreciate the general positive sentiment in a world of kind of negative noise, as you described it. So thank you for that, Ken. And as a reminder to everyone on the phone, we will follow up with a copy of the presentation and a recording link. And we appreciate your partnership. Look forward to seeing you at our next session. In the meantime, happy holidays to all. Thank you very much.
Thank you, folks. Have a great holiday.